You already know this, but it bears repeating. Your credit history is really important to your financial life. Poor credit doesn't only mean being denied loans. It also means that whatever loans you do get will cost you more. And why wouldn't they? I mean, you do seem to be riskier to lend to, so a lender will ask for more money to compensate for the risk. But did you know that not all credit blunders are created equal? Did you know that some are forgivable, while others, not so much? In this video, we take a look at the top 8 credit mistakes in increasing order of drama. Hi, my name is David Ponce and I'm your friendly neighborhood mortgage broker from Montreal, Quebec. On these videos, we explore mortgages and all their quirks and features, and we also learn a little bit about finance and credit. If you never want to miss any of these fascinating videos, make sure to like, subscribe, and most importantly, hit that bell icon so you get notified when I post. The credit blunders we're going to look at will be seen through the prism of mortgage lending. Keep in mind that mortgage loans have a mitigating element inherent in them, the property being offered as collateral. This means that you're more likely to actually be offered a mortgage loan, given some factors, than you are to be offered a loan with no security attached when your credit is in shambles. So without further ado, here's number 8 in our descending list: loading up your revolving credit. First off, revolving credit means stuff like credit cards and lines of credit. It's credit where the debt can go up or down, depending on your habits. It's different than a simple loan on which you make payments and the principal goes down over time. If you start loading up your credit cards past the 30% mark, and especially the 50% mark, your credit score will start to go down. This means if you have a card with, let's say, a $3,000 limit, you shouldn't use up more than $1,000. If you ever get over $1,500, your credit score will start to go down. If you're over limit, it's gonna plunge. But the good news is that it can also bounce back. As soon as you pay this off, your score recovers. It's sort of a no harm, no foul. The lower the score in this case is just a measure of your risk at that moment, not a statement on your repayment habits. Moving on to number 7, being over 30 days late on something. This isn't really news. You kind of knew that you needed to pay your stuff on time, but you should know that it likely won't end up on your credit report unless it's over 30 days late. But once it's there, it stays there a while. Yep, 7 years. Now, one late payment isn't gonna kill your score, not even 2 or 3, but anything over that and it starts to look a little fishy. Also, it matters when they happen. Were they all clustered in a short period of time instead of here and there? Well, if that's the case, it's a little more understandable because maybe there was some life event that happened that caused the lates versus you're just someone who doesn't care about paying on time. Number 6, being over 90 days late on something. Continuing in order of increasing drama, you really don't want to get into 90+ day late territory. When you see a credit report, we actually very quickly see the number of times each debt has been 30, 60, and 90 days late. When you start seeing lates in the 90-day range, there better be some good explanation for it. If there are many scattered over time, you may no longer qualify for an A loan, unless it's been a while, usually a year or more. For more on what an A loan is, click right there. Number 5, getting an R9. An R9 means your revolving debt is now officially bad debt. The credit grantor has officially given up on you, they've written it off, and you are now officially a bad payer. An R9, along with an M9 for mortgages or an I9 for installment loans or any other letter followed by a 9, is bad. Really bad. But, surprisingly, there are worse things. So let's look at number 4, getting a collection. This is the natural step after getting an R9, but it doesn't always happen. Maybe you end up paying your debt before the collection agency files its report. But once it does, it means your debt was so bad it had to be referred to a collection agency who will call and harass you and bully you into making you pay. It means that you're not to be trusted with money and it can be very difficult to get you financed. Still, for a mortgage loan, because of that security, you can sometimes get approved. Definitely not with a traditional bank and with an A loan, but some alternative banks might lend you a hand and help you get your financial life back on track. So yes, there is worse. Number 3, going bankrupt or declaring a consumer proposal. This one is not a surprise, right? You went bankrupt. You went to see an insolvency trustee and you basically said, that's it. I give up. I'm never gonna be able to pay this debt off. Please help me make it go away. And it does. The creditors will never see their money again. they lose. But you in a weird way don't really win, right? This follows you and it stays on your credit report for 7 years. It'll make it hard to get credit cards or even little loans. Interest rates on what loans you do get will be sky high. Now note something, consumer proposals are seen exactly the same way by banks. They're just as bad. As far as mortgage loans are concerned, there is worse. Number 2, being late on your mortgage. Look, first of all, if we got this far, you're already not being approved for a mortgage loan in a traditional bank. But as we've just seen, there are banks willing to take a chance in some cases, even with situations that are pretty bad, even bankruptcies, undischarged consumer proposals, collections. But being late on your mortgage? Well, no. That's a big no-no. That's gonna be a hard stop for a lot of alternative banks. And I mean, it kind of makes sense, doesn't it? They want to make sure that no matter what, your priorities are in the right place and at least your mortgage is well paid. The only way out? Wait 12 months. Usually alternative banks will accept to go forward again when it's been 12 months you haven't been late on your mortgage. Which brings us to number 1, the worst thing you can do to your credit: going bankrupt twice. Yes, it happens. Yes, it's bad. Yes, it does mean you can't be trusted with a loan. And no, you can't really hide it. While the first bankruptcy stays on your credit report for 7 years, the second one stays there for 14 years. That's a long time. And even if the one fell off the report because it's been longer than 7 years, you can't even pretend the second one is really the first one. Why? Because the first bankruptcy takes 9 months from declaration to discharge. The second one takes 2 years. You can see this on the credit report. We'll know right away it's a second bankruptcy. When a bank finds out you've gone bankrupt twice, well, that's it. And this counts consumer proposals too, so don't think it'll be any different if you have a consumer proposal and then a bankruptcy. A bankruptcy is kind of a second chance at life. It comes with a 7-year punishment, which is pretty harsh to start with. But if you do it again, yeah, that's hard to beat. And so there you have it, the top 8 worst mistakes to make with your credit. For more videos like this, tune in next time. Now, this isn't really news. He gets annoyed that I'm with his tail.